The stock market continues to fall because of everything that has been happening with the Fed, interest rates, inflation, and more. Hello everyone, welcome back to the channel. Today I wanted to talk about what is going on with the market today, as we saw that it started in the red and it continued dropping throughout the day. And we have seen that throughout the whole 2022, which has been like about 3 weeks, it has been dropping and dropping, excepting for about 1 or 2 days or something like that. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. And check the links down in the description below. Now, let's go to my computer to check what is going on with the stock market. First of all, we can see that everything is red. The S&P 500 is down 1.65% today. The Dow Jones 1.25%. The Nasdaq 2.23% today. And the Russell 2000 2.15%. One of the first reasons of why the stock market dropped this much today, it's because of this. And the 10-year Treasury yield hits 2-year high, hovers around 1.86%. We can see here that the US 10-year Treasury is up massively since December 2021, but it has been going up and up and up, and today it got to a record of 2-year high. Now, we know that this is not that good because this is going fast. And what this tells us is that basically indicates that investors are preparing for a possibility of a more aggressive tightening by the Federal Reserve, which obviously is something that we're already pricing in the stock market, but we have a long road ahead. Something very important that the Fed said here, or that CNBC is saying in this article, is that the reality is that the market is still adjusting to the Fed's ongoing hawkish evaluation. But people are scared of a recession if this continues, but according to them, it's not in the Fed's interest to see the 10-year spike up to 2%. It's at 1.8%, so it's not at their interest to spike to 2% by the end of January, trigger a decline in consumer expectations, a sell-off in equity markets, and trigger a recession, meaning that they are aware of this and they don't want the 10-year Treasury to spike up to 2%. So they will act if this ever happens, as they don't want the market to get ahead of themselves, as they do have basically a plan to beat inflation or to fight against inflation, which is increasing interest rates. But the 10-year Treasury yield going up this fast is not in their plan, so they will have to act about that. Because we are pricing this in the market, and the market has been dropping because obviously interest rates going up affects companies and affects several parts of the economy. For example, last year we saw a huge uptrend in housing market prices, mainly because interest rates were so low that when you were to go and buy a house and you went to the bank to ask for a mortgage, they would give you an excellent interest rate for your mortgage of about 2%, let's say, to 2.5%, depending on your qualifications. But if you get an interest rate of 2.5% for your mortgage, which in my opinion, I know of people that got an even lower interest rate, but let's say 2.5%, that was basically free money, because normally the inflation in the US is about 2.5 to 3% year over year. But right now, because of everything that have been happening, because of all the money that they printed and coronavirus and all that, we saw inflation going up and up and up. Right now it's at 7%, but last year was at about 4, 5, and 6%. So if you were getting a mortgage with an interest rate of 2.5%, that was basically free money, and everyone was taking advantage of it. Other than that, we also saw a spike in demand, for example, in Florida, from people coming from New York or California, moving on, as Florida was a cheaper state in comparison because of taxes and all that. So obviously the demand increases and the prices of the houses increases as supply was not that high. But obviously interest rates were also affecting housing market prices, because right now that the interest rates are going to start going up, we're going to see how the house prices are either going to stay flat or start going down. And I have read a lot of news already talking about this, that the price of the houses are starting to go down, and this is one of the reasons. Now, obviously the stock market is going down because of interest rates, but even though we believed that this was already priced in, apparently investors are basically preparing for a possibility to a more aggressive tightening by the Fed, which obviously is not that good. It's good because they will fight inflation and all that, but that will affect companies more aggressively, because remember that just as you have to pay interest for a mortgage, companies have to pay interest for their loans as well, and that will make them have an increase in expenses and a decrease in profits, while our expectations will change in the long term from different companies. That's why non-profitable companies are the most affected ones, even though we are seeing that almost every company is down today. Now, another news that came up today was that Goldman Sachs shares dropped 8% after earnings miss in surging expenses, equities trading slowdown. Surging expenses, just like JP Morgan and Citibank, both saw expenses going up. Not Wells Fargo, they saw a jump in profits, but Goldman Sachs, JP Morgan, and Citibank saw a huge increase in expenses because of different reasons, which they talk about that in this article, but I mentioned that on my bank's video. But first of all, they posted the fourth quarter and expenses increased 23% year over year on higher pay for Wall Street workers and increased litigation reserves. Now, earnings were $10.81 per share, and analysts were expecting $11.76 per share. Their revenue was $12.61 billion, beating analysts' expectations of $12.08 billion, which was actually up about 8% year over year, as it says here. But now, they saw a profit decrease of 13% year over year. And obviously, investors and analysts do not like that much. But just as the rivals, JP Morgan and Citigroup, Goldman Sachs expenses rise in the quarter as the firm had to pay employees more after another year of outperformance. And I have to say that I have proof that this is happening. I have a friend that works in one of these three banks, which I don't know if I'm able to say, but he's working in one of these three banks, and he just got a raise about a month ago, plus the bonus and everything, because we are seeing this competition in the market and in Wall Street. That's why they say here that Goldman Sachs' disappointing quarter four earnings are a stark reminder that wage inflation is hitting the bank sector hard. And it's not only the bank sector. Yes, might be the most affected one, but it's not the only one. Still, investment banking revenue jumped 45% in the fourth quarter to $3.8 billion, exceeding analysts' expectations, estimated by about $550 million. Obviously, that's why stocks dropped. We can see that still the stock is down 6.49%, and in the past 5 days is down 10.97%. Now, tomorrow we're going to see Bank of America reporting earnings, so I'm very, very interested in that to see how they are doing in comparison to the other banks. On another note, we saw that Microsoft is going to buy Activision Blizzard by $68.7 billion, which is an all-cash deal. And I know that the Activision Blizzard stock went up 26% today, while Microsoft stock down 1.97% today. I do have to say that obviously some people did not like this deal because of the price that they're paying for Activision Blizzard. Because we can see that certainly today, the valuation, the market cap is $64.38 billion, but the stock is up 26%. So yesterday or last Friday, the stock did not have a market cap of $64 billion. It was about 46 or 47, if I'm not mistaken. I don't remember correctly. So they were overpaying in comparison to their market cap. But still, this is going to be maybe good for Microsoft, as they have been investing a lot of money in the gaming sector, as they have been expanding, and this might help them expand more. The price means Microsoft will pay $95 per share for Activision Blizzard. That does not mean that if you buy today at 82, you're gonna get to $95 per share. No, I would not buy it today because the stock is already 26% up. If you were already in this stock, congratulations, because the stock is up 26%, and in the past year it's actually down 11%. So it has kind of recovered from that drop a little bit. But still, this might be a good deal for Microsoft if they use it correctly and intelligently to continue expanding, as we know that the gaming sector has been growing and growing, and the gaming industry is expected to continue having a huge growth in the long term. I do have to say that Microsoft said it expects to close the deal in its fiscal 2023. However, US regulators have signaled they will be far more aggressive in evaluating large acquisitions, especially in the tech industry. So there's a chance the deal dies under government review, meaning that today they are planning to acquire Activision Blizzard, but next year when they're planning to close this deal, the government or regulators might say no, and then they won't be able to buy it unless things change in the deal. Now, on the crypto market, I don't talk that much about crypto on my videos, but now that I know many of you are interested in it, we're also seeing Bitcoin dropping today, and Ethereum dropping today, and many others dropping today in the past 24 hours and in the past 7 days as well. But yeah, let me know in the comment section below what you believe it is going to happen with the market, with all these news about a 10-year treasury, with Goldman Sachs and Microsoft and all that. I don't see the stock market reversing anytime soon, as we see it continue dropping. But well, I'll leave you here my video on my new portfolio in M1 Finance, and here for you to subscribe to the channel. Thank you and see you next time.